Our guest tonight has been practicing real estate and corporate law for the past 30 years. He's represented thousands of clients in property tax appeals, and he's had millions of dollars returned to clients for tax overpayments. He's currently on the Florida Bar Tax Section's Executive Council, and he serves as the chair of the Ad Valorem Committee of the Florida Bar State Tax Division. So please welcome Seth Lubin. Thanks for being with us, Seth.
Thank you, Jason. I appreciate the opportunity.
Absolutely. Pleasure to have you here. So what is tax portability? What's it all about? Tax portability. Why is it there? How do we calculate it?
Yeah, so before we talk about portability, and I wanted to, and I put together a little presentation because it's important that we understand property taxes in general. And I don't mean in the legal sense. I mean just in the general sense. What does the layperson, the buyer, the seller, the homeowner, what do they need to know, and how do they understand what property taxes are? Because if we start talking about portability, they might get lost in the lexicon of value terms, and there's so many things that go into it. So if it's okay with you, Jason, I would love to be able to run through this. It's not very long. And during the presentation, if anybody has questions or you have questions, you can stop me and I can answer them as we go along. It's not a thing where we have to wait till the end to ask questions. It's up to you if you see something relevant. So let me go ahead and start this here. Okay, do you see the main screen there?
Not yet. I'm not seeing your screen. I'm still seeing the Downsize and Simplify webinar series. Do we need to give you authorization?
Okay, so you don't see a picture. You still
now,
see mine?
Now something's starting to happen. I'm seeing a black screen here with you and me on the left.
Okay, and it didn't say property tax primer?
I'm not seeing it quite yet. I see a black screen with you and...
Oh, okay. Hold on. Let me try something. How's that?
It might take a second to register. It's still showing a black screen. And we have a question too while we're doing that from Pete, Seth. He says, in Maryland, there are real estate tax benefits that are not portable, i.e., when someone moves, the benefit is lost. Two examples are the homestead tax credit, which can significantly reduce real estate tax benefits for owners that have been in residence for a long time. Additionally, there's an aging in place tax credit, which is a 20% credit against the county portion of the tax, which is lost when the homeowner moves. How is this balanced against the tax reduction expected when downsizing? Is that something you can speak to?
Well, I can't really speak. You see the screen, but okay. Well, we can use this. I can't really speak to obviously the other jurisdictions' credits, but we can talk about portability. We can talk about downsizing and how that works, and what kind of values do you have to have in order to really show some type of benefit from portability. It's going to be different in every jurisdiction, and it's even going to be different within each jurisdiction. So it's hard for me to answer that question because you can't really compare the two. Let me see here. Okay. So you see something there, but when I do this, you don't see anything.
Correct. Yes.
Okay. All right. So you'll see the thumbnails, but that's okay. So first, before we talk about portability, we have to determine how property values are determined. How do they even determine what that value is so that when you get to your portability, we can make that calculation correctly. Then we're going to talk about how property taxes are calculated, including how do we calculate portability. And then if there's time, we can talk about how to appeal and then some of the property tax myths that are out there. First of all, how property values are determined. Really, Florida law is very clear on what the property appraiser is supposed to do in order to determine value. They have to consider 8 different things when determining value of property. I'm not going to read through all of these, but you can see number 1 is the one that we really use all the time. It's the present cash value of the property. What did somebody pay for the property? The important part is, though, that it has to be a willing purchaser and a willing seller. In other words, it has to be arm's length, so no foreclosures, no short sale values, anything that, auction, anything that's really going to take it out of the hands of the buyer or the seller are not going to be considered a valid sale. Location of the property obviously is very important. Are you on the water? Are you on the intercoastal? You have an ocean view. The cost of the property for replacement, the condition of the property, all of these things are supposed to be taken into consideration. So the bottom line is this: to determine how much you pay in taxes, they take your home value, they multiply it by your tax rate, and you get your ad valorem tax amount. It's that simple. Now, the reason that I put ad valorem tax amount is because you will also have non-ad valorem, meaning that it's not based on the value of your property. Sometimes you'll have a fire district in your area, and they will add on another $200 or whatever it is per property. It doesn't matter if you have $1 million house or $100,000 house, you're going to be charged the same thing. Okay. So when we talk about the home value, we're going to see a lot and hear a lot about different terms: market value, assessed value, and taxable value. So how do we break those down? The market value, it's also called the just value. In other words, what can you sell the home for? What do you buy the home for? That's your market value. The assessed value, on the other hand, is the market value minus your portability, which we'll get to, or your Save Our Homes value, which is a capped value on the property that cannot, meaning that if your property is homesteaded, the value cannot go up by more than 3% or the consumer price index each year. And so your assessed value is probably going to be anywhere between 1% to 3% increase, even if the market value, like we know in 2021, the values are going crazy, right? Mm-hmm. If you're homesteaded, the market value could increase by 10%, but your assessed value can only increase by a maximum of 3%. Then there's taxable value, which is really just the assessed value minus any exemptions that you have. So let's show you. This is a property card from Broward County from a few years ago, just to give you an idea. So this home sold. This home was valued, had a just value of $371,450. It's possible that that's what they purchased the house for. Mm-hmm. So that's your just value. Then we see right below it, they took off portability. So this home had a portability of $74,950, and we're going to talk about that in a minute. Mm-hmm. They took that off of the just value to get to the assessed value, right? So $371,450 minus the portability of $74,950 is $296,500. We then have exemptions. We have our homestead exemption. We take off $50,000. And we arrive at our taxable value of $246,500. All right. So we'll remember that number, $246,500. That's the taxable value of this property that had a market value of $371,450. But let's talk about portability real quick. So portability was added to our Constitution in the 90s because of the rising values and the fact that people were stuck in their homes, because as the values increased, they knew that they couldn't go to another home that was valued more, because they were going to get hit with property taxes that were too high. So they said, all right, if you have a portability savings, which we'll talk about, in your existing homesteaded property, then you can port that difference over to your new property, whether it's an upgraded property or a downgraded property. Now, keep in mind, portability will only work. You only have portability if you're homesteaded, if you have a homestead exemption. So if you have an investment property, or if you're leasing out your property, or you have two properties, you can only use the portability on your homesteaded property. All right, so here's an example. For this property card that we saw before, we're going to say that the house that they owned before this one, their former homestead, had a market value of $280,000, and their assessed value, or their Save Our Homes value, was $205,050. So we look, what was the difference between the market value and the assessed value? Of the previous homestead, that difference came to $74,950. You now deduct that amount, that $74,950, from your new market value to get to the assessed value. So that's exactly what happened in this scenario. So their previous homestead, they had that $74,950. They deducted that portability from their new property to get the assessed value of $296,500. So that's one example of downgrading. Now, keep in mind, even though it shows that there's a difference between just value and assessed value for this existing property, we're not looking at that. We only care about your former property. And also, we have 3 years from the time of your sale to take advantage of this portability.
3 years. That's interesting. Okay.
Right. It's 3. It used to be 2. But the problem was that it was 2 years from the date you sell, and the legislature said, no, it really should be 2 full years. So what they did was they said it could be up to 3 years, but it has to include 2 full years. So that's one example of the downgrading. I'm sorry, of the upgrading. Now we're going to talk about the downgrading. And I use the same property card because I'm changing the scenario of what their previous house was. If you remember in the last example, they had a house that was only worth $280,000, and they were buying a house worth $371,000. They were upgrading. Mm-hmm. Now we're going to downgrade. We're going to say that their former house had a market value of $580,000, mm-hmm. and their assessed value was $462,956. So what was that difference? Just like we did in the previous example. But in this case, the difference is $117,044. Now, because they're downgrading, we cannot just subtract that difference in value from the market value. That's what we did in the previous example for the upgrade. But for a downgrade, it's based on a percentage. And the reason they do that is because what happens if you downgrade so much? Let's say you buy a $100,000 condo, that would wipe out all value. So you're not going to wipe out all value. So they do it based on a percentage. So they look at the old market value, the $580,000. They look at that difference, that $117,000, and they come up with a percentage. So that difference in value is 20.18%. You then take your new market value, that $371,450, multiply it by that portability percentage to come up with the amount of savings. So it just happens to work out in this case that savings would be $74,950. So you see Anita and Paul Prezzamolo, if they upgraded, then they could save $74,950 if they bought a home that was worth $280,000. If they downgraded, they would have to have had a home that was valued at $580,000 and had an assessed value of a little more than $100,000 less in order to get that same portability. So portability becomes a lifesaver for people that really wouldn't necessarily be able to afford to, go on to your next home. And it's a nice bonus. A lot of people they take it for granted. Now, what happens is when you file your homestead, a lot of times the property appraiser, or there'll be language in the application that says, do you also want to apply to portability? And most people would just say, yeah, like they don't really know, but they do it. But it becomes a good tool. And for the realtor, it's also a good tool, because if there's any type of trepidation with your buyer to say, oh, I'd really like this place, but the taxes are going to kill me, you can inquire, well, what kind of portability do you have? What is the difference between where you live now, your just value and your assessed value? Because you're going to take that and you're going to apply it against the value of your new home to reduce that value and that tax burden.
Great information, Seth. If I may, as a realtor in the market, you hear that a lot. Like, okay, where am I going to sell? If I sell, I'll downgrade, I'll downsize rather, and my taxes will be higher than what I'm paying now. So as a rule of thumb, yes, no to that question. Is that accurate if they've been in the house for say 10, 20 years?
Yeah. So what happens is, and that's a great question. What happens is, and I'll go back to this example on the upgrade, the longer that you're in your home with Homestead, in a good market, in a positive market, you're going to see the just value increase year over year over year. And remember that example I said that the just value could go up 10%, but your assessed value is capped at 3%. So let's assume that over the course of 20 years, let's say you've been in your house for 20 years, you know that the value of that house has probably gone up over 100%, right? Over 20 years, depending on the location and everything else. So as that market value increased, a great example, the first home that my parents bought in 1957 in Miami, I think they paid like $20,000 for their home. When they sold it in the 90s, they sold it for close to $300,000. So what happens is over time, we know the market will usually go up, and the longer you hold on to the house, the longer that difference between the market value and the assessed value grows. And that's your portability. So the longer you've been in the house, most likely the bigger difference you're going to have between your just value or your market value and the assessed value.
So that helps you then. If you've been there for a long time, it does help you to lower your tax costs on your next property after you move then.
100%. And just keep in mind, though, that there is a $500,000 limit to how much you can port over. So even if you have $1 million in portability, you can only bring half of that. You can only bring 500,000 over to a new property.
Understood.
Okay. Now Jason, you had asked a question earlier about the 1% versus 2%. So yes. If you look in the top left of the screen, you'll see where it says home value and tax rate. We talked about home value. I think we have a grasp of how we determine what that home value is. But now we got to talk about that tax rate. So we know that value was $246,500, that taxable value when we went through it. Now we got to talk about tax rate. How do we determine 1%, 2%? Well, each district within your area has a little piece of it. They get to charge the homeowner or the property owner a little bit of their value. So in this example, if you're in Weston, that's where my office is. That's where I live. In the city of Weston, they're going to take $1.5235 for every $1,000 of value. And they're going to use that money, by the way, to fund the police, the fire, to do road improvements, things that are Weston specific. Then there's children's services, hospital district, school board. And you can tell the school board is the largest one. And we'll get to that in a second. Then the county gets their little piece. So everybody's getting a little piece of the pie. The school board gets the largest piece. When you send your kids to public school and you don't have to pay anything, it's because everyone's paying their property taxes. And $7.41 in this example for every 1,000 property value goes to the school board. And the school board has a huge lobby. So they're going to constantly lobby to try to get the most they can out of these dollars. And so in this example, we added up all of these little pieces of pie that people wanted, and it came to $16.99 or 0.9948. But we do it as a millage, and I'm sure you've heard that term millage rate, right? Yes. We do it as a millage, meaning we divide it by 1,000, and that becomes our tax rate. So in this case, we added everything up. It came to 16.9948. Divide it by 1,000, and we get 0.01699948 or 1%, 1.69948%. So,
good question, Seth. Yeah. So in Coral Gables, is it beyond 2.2%? That's what comes to mind in Coral Gables, for instance, a different city.
Yeah, a different city. Yeah, but it also depends where in Coral Gables. Coral Gables will have their millage rate. So just like you saw, City of Weston has $1.05. I mean, $1.52. The City of Coral Gables will have that as well. But then you might have different districts in different areas of Coral Gables. And what I can do if you have questions from other people, or if you're going to talk, I can then look up that for you. I can pull up that millage rate for you for Coral Gables.
Yeah, that'd be great. Anyone, if you'd like to chat there in the private chat, put whatever area, if you'd like to find out what your millage rate is, I'm sure that could be interesting. Yeah, the rule of thumb I've always used as a realtor is 2%.
Yes,
and then
that's the rule of thumb I use as well.
Perfect. So the client today who said, no, Jason, I've been looking online, and everything where I see online, it says 1%. She was seeing it without the different add-ons that you just mentioned, correct?
I maybe that's a great point, Jed. Maybe they've done that. I would be hard pressed for me to find any jurisdiction that had 1%. I've never found that in Florida.
So an additional question, if I may. So somebody wants to buy a $500,000 house. That's what it's being offered for on the market today. Say they pay full price today, $500,000. Is it fair to say that their property tax bill next year will be $500,000 times that 2% or 1.6%? Is that fair to say, or is that not fair to say because it's assessed versus market or just value?
Right. Did you say that they bought the property for 500 or that it is valued at 500?
It's on the market now for sale at 500. They're interested in it. If they're saying to me, Jason, if we buy it for 500,000, what will our taxes be? And that really determines if they will make an offer on this property, because if it's at 1%, it's affordable for them. If it's 2% taxes, it's not, and they'd rather go to a lower price point than 500,000.
Right. That's a great question. Let me do this first. Let me stop sharing my screen. Let me get back on here. Stop sharing. Okay. So great question. So let's take the scenario that somebody pays $500,000 for their house. The way that, if you remember when I first started that presentation, I said that the property appraiser in the Florida law, they have to consider 8 different items to determine what value is. First one being, right, the market value. The 8th one, which we didn't talk about, talks about the cost of sale. How much is it going to cost for me to pay the realtor as the seller, right? How much is it going to cost for me to, or the buyer, to pay the realtor, to get title insurance, to pay my attorney? There are costs of sale that are associated with every sale. So what the county has done, each county has determined what that cost of sale is for their individual county. And in Broward County, they do it based on a cost of sale of 10%. Miami-Dade County goes anywhere between 10 to 15%, depending on how nice they're being at any given time. So let's use the example of 10%. So at a $500,000 house, you take off 10%, which is $50,000. The value, the market value, would start at $450,000. Then you say, well, approximately 2% of that, which is $9,000. And that would be your approximate ad valorem taxes. Now, again, there might be non-ad valorem, but your ad valorem, the one that really makes a difference, would be the $9,000, which is 2% times the $450,000 value.
Good to know. So take off 10% of the purchase price, and then you do that 2% times the purchase price minus 10%.
Correct.
Okay, that's good to know.
And in the meantime, what I'm going to do is I'm going to try to pull up some property tax rates in Coral Gables. So let me go to the property appraiser's website, and I'll try to get that done now.
Thank you. Any questions so far, folks? Feel free to put in the chat box there, or any questions that come to mind. Any thoughts, questions, comments?
Yeah, let me just say, while people are thinking about that, I like I said, I've been doing this for a very long time, and I'm one of these weird guys that actually loves property tax law. It's a niche. And the reason I'm saying that is because when I'm talking to people about property taxes, I think sometimes I assume that people know as much as I do. And so I, I sometimes talk over them unintentionally. So I'm only saying this that in the event you have a question, don't feel that it's a stupid question, because there's no such thing as a stupid question. And the only way, that's how I got to where I am, is by asking questions. And I think we all learn that as life lessons. So if you have any questions at all, even if I've already answered it, or even if there's something that you don't understand, I would love to help you out and explain it to you.
Thank you,
And I
Seth.
hope I'm not being condescending. I wasn't trying to be.
Not at all.
Okay.
Super helpful. Phil Stam, do you have a question, sir? Yes, he has a question. Go ahead, Phil.
Yeah, hi, Jason. Thank you for putting this on. Seth, nice to meet you. Thanks for this program.
Same here.
I have a question. In my mind, I think portability applies to this. You tell me. I bought a house 20 years ago. Of course, it's increased in value substantially, but I've also added onto the house, doubling its size. So does portability apply when they revise the tax roll and increase my square footage on the tax roll, which they haven't done yet? When I finish the building permit finalized, they're going to do that. Are they just going to double? How do they establish the new value? Is portability going to save me anything?
Good question, Phil. We don't hear you, Seth. I think you're on mute, Seth.
Yeah, there was some feedback, so I muted in case it was me. So that's a great question, and I wish I had a better answer for you, but I can tell you that it's very possible that as a result of adding on, if you increase the value of the property by more than 25%, they're going to reassess you. They're going to take that big difference that you have between your market value and your assessed value right now, and they're going to equalize it. And once they do that, you lose your portability. And you also lose that Save Our Homes protection, where you might have been paying a small amount down here, and now all of a sudden they're going to move it up, and you're going to end up having to pay more. Is this Miami-Dade County?
You're on mute, Phil.
Yeah. Yes, it is unincorporated, and I also wanted to ask, how are they going to assess the value? Is it just on square footage?
Yeah, they're going to look at the square footage of your property. They're going to do it one of two ways, whatever gives them the better value, the higher value, I should say. What they're going to do is they're going to take it as an overall product. What is the full size of the property? And they're going to find other properties that are similar to yours in your area with that same square footage or very similar square footage in the same location. And they're going to look at those sales. So if it'll be reassessed as of January 1st, 2022, they're going to look at 2020 sales. 2021 sales. So whatever sales in 2021 that were similar to the specs that you have is going to determine what that value is. That's one way. The other way they might look at it as, well, you added on X amount of square footage, and we assume that it's $250 per square foot. So they're just going to add on that extra amount. Most likely it'll be the former of what I said. They're going to just look at it as a whole with the new square footage. And they're going to find other sales from 2021 that have similar size, has a similar size property. Did you want me to pull up your property right now as an example, and we can take a look at that?
I guess you can.
What is the address?
My assessed value is 148,705.
And what's your market value?
254,324.
Okay, so you have a little over $100,000 in portability, right? So what will most likely happen is you're going to see, again, if there's more than 25% size difference, they're going to go ahead and reassess that and put that Save Our Homes value back up to that $250,000 number. So you lose your portability, but you're also you're also losing about $2,000 in savings. So
I'm
figure for every,
confused. I'm sorry, I'm confused. I believe I can sell this property today for about $1 million. Why is the market value 254?
well, if I can pull it up, if you want to give me your address, I'll be happy to
Okay.
pull it up and I can tell you by looking at it.
20831 Southwest 256th Street.
You are south.
Okay.
The place to be,
Big
man.
land. Big land.
There
Big
we
land.
go.
And that's interesting because you hear these market values, like Phil is saying right there. Market value on the tax roll is down here, but real market value, what a buyer will pay, is always up here, like all the time, except for in 08, 09, when the prices dipped. That was the first time I ever saw real market value being less than what the county had it at. But it's such a disparity, as Phil just mentioned.
Yeah. So
It's almost a misnomer, market value, because it's not market value.
okay, so in your case right now, all right, is it sharing? No, it's not.
Not yet.
Okay, oh, I see. Okay, so now you see it on the screen. Here we go. So this is the property that we're talking about, and you can see on the left side here in the middle, it shows that the market value for 2021, which really is the value as of January 1st, like you said, is $254,324. They arrived at that because that's what they believe the property is worth based on other sales, I guess, they've had over the past few years. So it's not a situation where the market value has gone up to $1 million, but you're capped at your assessed value at $148,705. So you can see the difference there. What's going to happen is it doesn't matter what you're going to sell it for. What matters is if there have been sales in 2020 or 2021 that are $1 million, then yes, they can reassess this property from scratch and pull that up to $1 million. But we don't know if they're going to do that. We'd have to see other properties that are very similar to yours, which I'm not sure if they're going to find too many in your area.
Would you agree?
But yeah, now just a wait and see on this one.
Okay, so let me ask you, once I finalize the building permit, my neighbor half a mile down the street finished his addition, which was the same as mine, doubling the house. He finished his 5 years ago. Tax rolls haven't changed.
Mm-hmm.
When they finally catch up, are they going to go retroactive for all those years, or are they going to start from that moment?
No, but again, the market value can go up. So it's possible that they can bring that up, but it won't be retroactive. So if he did it 5 years ago and they didn't do anything, there's nothing they can do unless he increased it and didn't pull permits or they didn't know about it. And then they find out about it later. But in that scenario, no, it's not retroactive. And it's very possible that the same thing might happen to you. It's very possible that when they reassess it, they're going to keep it low. However, like I said, you'll lose that portability, though. You'll lose that difference between at least the initial portability, and then over years, you can build it back up.
And the law is not about to. I think that stinks, and the law is not going to be amended to fix that anytime soon. You don't think, right?
No, what part stinks? That you're going to lose your portability by expanding?
Yeah.
Yeah. I mean, they do that so that you're taking away the possibility that people will just start building up or building out on their property and not be subject to additional property tax. But yeah, I agree with you in a sense. There's lots of problems with this law, and for years it's been challenged, and for years it keeps winning. The state keeps winning in court. And again, I think that also goes back to the school board lobby being so big that they have a big hand in doing everything they can to keep those values high. Let me do this real quick, Jason. I have the answer to your Carl Gables taxes.
Perfect.
And I'm going to share this here. Let's see when it pops up.
Mm-hmm.
Hopefully the text isn't too small. I don't know why it's taking a while. Oops. It looks like I had it and then I clicked out of it. Give me one more second.
Take your time.
Okay.
Great question, Phil. Thank you for sharing, your thoughts on a real life situation like that. It makes it very much more easy to understand and digest.
Okay, this is just a random property I found in Coral Gables, 322 Villard Avenue or Villarde Avenue. This property, we're going to break down. Now, this, by the way, is available on the property appraiser's website. There's a link to every property, and then you can click where it says property taxes, and it'll pull up your property tax bill. So this is what a typical property tax bill will look like, where it has your ad valorem taxes. And remember those different districts I was talking about? We had Miami-Dade, we had school board, we had others. So in this case, what we've got the school board, and they have $6 and 0.79 for every $1,000 in value. And you see they're far more than everyone else. The state, inland navigation, Okeechobee Basin, Miami-Dade County, they get a big piece too. The countywide operating 4.66690. And then the municipal governing board, Coral Gables operating 5.5590. So remember, a lot of this up here for Miami-Dade County could include everything from the stadium, the Marlin Stadium, to here's the library district. So all of these things get built in. They add it all up. And if you look down here, total ad valorem taxes, it says 18.81560. And because it's a millage divided by 1,000, that is 0.01881,560, meaning it's 1.88%. So that's very rounded up to 2. So in this person's case, they were valued, and you can see on the right, they were valued at $579,919 multiplied by that 1.881560%, and they get the $10,911.54. And if you remember, I mentioned ad valorem versus non-ad valorem. If you'd hear some non-ad valorem assessments. So on top of that, that 1.88%, they also have to pay another $1,200 in non-ad valorem taxes, meaning it's not related to their value, but they pay it for the Coral Gables Fire Service and the solid waste. So that's how they determine. So yeah, so if you want to say Coral Gables themselves really only has 5.5590. I say only, but that's a small piece of the total. So it's really 0.5% of your property taxes in Coral Gables actually goes to Coral Gables.
I have a question, Seth. So Coral Gables versus City of Miami, can you cite an example? How does that compare? Coconut Grove?
I don't. Unfortunately, I don't have it on me, but I could put together a list, but I don't have it of every municipality, because right around October of every year, that's when they vote to determine what their district or their municipality or governing body, what they're going to be charging. And that's because they have to put in the budgets for how much their police department and everything else for the year. And they determine, well, how much money do we need in order to run our municipal government? And that's when they determine what that tax rate might be as a result. So, I could pull up a property in unincorporated Miami-Dade. I can pull up a property in Miami and tell you what that tax rate is. But there's usually a list that the Miami Herald will publish of each of the municipalities and what their tax rates are.
Interesting. Okay.
Oops. That screen. There we go.
Thank you. So a question. Are there things that people can factor in or prepare for if they are looking to downsize? Anything that could help them from a tax standpoint to increase their portability or to position themselves well before they make the transaction? Any thoughts on that? the sale and a purchase.
Yeah, I mean, there's not much you can do because the difference between the market and the assessed value is really all that matters in this portability game. So there's not too much you can do to control that difference between your market value and your assessed value. It's really market driven. So if the market increases, that's good for your portability. If the market decreases, that's not good for your portability. It might be good for your purchase price, but it's not good for your portability. So it's really a give and a take. I will tell you that usually when you are buying property, if you're going to either upgrade or downgrade, it's better if you're trying to buy at the end of the year, you're better off waiting until the beginning of the next year. And the reason is if you're buying property that somebody already has a homestead on, you get to take advantage of their homestead because the value that they determine for the tax year that you're going to be paying is January 1st of that year. So for example, if I buy a property on January 15th of 2022 and I'm buying a house that had a lot of Save Our Homes, like what I think it was Phil. If I went and I bought Phil's property on January 15th, I'm already locked in to Phil's Save Our Homes value. So I don't have to pay as the buyer. I'm not coming in. I don't have to pay the higher tax. If I buy his property for $1 million, let's say I buy his property for $1 million. Well, you know what? For 2022, I don't have to pay taxes on that $1 million on that value. I'm only paying taxes based on what the existing value was as of January 1st of that year. So I would only have to pay taxes on the $150,000 or whatever it was for Phil's assessed value for the rest of that year. Now in 2023, you're going to see the ramifications of that $1 million sale, meaning you're probably going to get a $900,000 value for 2023.
So interesting because so often, sorry to interrupt, people try to close before the end of the year for stated tax purposes. Yet here's an example where you want to close after the end of the year. Very interesting. First time I've heard that.
Yeah, I mean, for capital gains, sometimes people want to do it so they have the extra amount at the end of the year. But then we start talking. That's when you talk to your CPA. But for property tax purposes, it's better to wait. Now, remember, it only works if you're buying property that has homestead or a good Save Our Homes difference. That's when you want to wait.
Original owner type of thing.
Yes,
correct. Excellent. Awesome. So here, Phil has a comment here. I did some quick math. Construction in Miami-Dade is off the scale. Properties are being added to the tax rolls where before there was only vacant land. I estimate at least $2 billion with a B of real estate is being added every year. At 1.5%, that equates to additional $30 million every year. Why are they increasing the millage rate when they are already getting this extra cash?
I'm not advocating higher taxes, by the way, but I'll answer your question not in a devil's advocate way, but to really help you understand how that works. If the real estate market is doing so well that they keep adding properties onto the tax roll, that does several things. Number one, it increases what everyone's going to be making, most likely. It means that the market is going well. You're going to have to pay the police higher salaries. You're going to have to pay teachers more, things like that. And as you add on properties, you're adding people into schools. So they're going to have to get portables, maybe open new schools. They're going to have to maybe widen roads. There are things that happen on the infrastructure side when a city grows. So as they add properties onto the tax roll, they're adding expenses on too. It's not just an income. There's a corresponding expense to the municipal, the hospitals, the county, the city. They all have corresponding expenses that they're going to have to pay to go with that. The extra money, they budget that extra. That extra money doesn't. Hopefully, if you're in a lawful county, doesn't go in the pockets of your commission members, but they use it for the benefit of the homeowners and the taxpayers. So whether that means that they don't increase it, I know here in Weston, as things were building, they ended up accumulating a lot of cash, like in your example. But what they did was year over year, they kept the tax value level. So even though expenses were increasing, they were using previous budget amounts that were over budget amounts to pay for that. So, nobody's really getting rich here by having all of this money in taxes. What you're doing is you're paying people more. You're fixing roads, you're building hospitals, schools, things like that. That's what they're doing with that money.
Interesting. It's good to hear. Good to hear. Great observation. Great question, Phil.
And then if you send your kids to private school, like I do, you still have to pay a public school. So that's all part of our duty as citizens and as residents to put in part of your property taxes for the public school system, regardless.
Yeah.
And that's not a complaint. I am more than happy to do that.
Mm-hmm. Mm-hmm. Well, this has been very enlightening. 6:48 right now. Any other questions come to mind, anyone? And Phil, really appreciate your questions. It's been very, very good quality questions. That's helping us get a better understanding of this. And Seth, thank you. Thank you for the knowledge that you're imparting right here. So my takeaway so far is that it is close to 2%, the rule of thumb, property taxes. Another takeaway is that, say it's 500,000 for the true market value, what a buyer is willing to pay. You subtract 10 to 15%, and then you multiply that estimated 2% times that subtracted number to get what your taxes will be per year if you were to estimate it that way. Is there some type of calculator that can give you more exactitude when it comes to that? And where would one find that calculator?
Yeah, so Miami-Dade County does have it on the property appraiser's website. If you were to go to miami-dade.gov, it's probably easier to just put into Google search Miami-Dade property appraiser, and they will have on their website. You can even put tax calculator. So you put Miami-Dade property appraiser tax calculator, and it has a tax estimator is what it's called.
Okay.
And from that, you can then put in what your estimated sales price is going to be. You can even put the folio number of the property you're talking about so that it'll determine what the millage is going to be, or you can put the city and whether or not you're going to be using portability or transferring, your homestead. And then you can hit estimate property taxes and it'll automatically do that for you. So do a search for tax estimator, Miami-Dade County property appraiser.
Perfect. Well, and question, say somebody feels like their property taxes are too high. That's when they call you for the property appeals, correct?
Correct.
How does that whole process work?
So what happens is the state of Florida allows the property owner to appeal the value of their property. And a lot of times, for your sake, Jason, you want property values to be higher, right? Because I think that's good for the real estate market. And as a seller, you want your value to be as high as you can. Now, buyers obviously don't want it to be high, but the seller wants to increase or maximize the value of their home. The downside of that, though, is the higher the value, as we saw, the higher the taxes. So if you know you're going to be in a property for a while, you might as well fight the taxes. And you do that by hiring, it could be a realtor, it could be an appraiser, it could be someone like myself. You hire a tax agent, somebody who knows about property taxes and how to fight property taxes. And what I would do is I would go in and I would lower the value by presenting comparable sales that are similar and making adjustments to those sales to equalize it to yours. And if that number comes out to be lower than what it's currently assessed at, then you have a savings potential. And what will happen is this, you'll most likely get a check back from the county like you do with the IRS when you overpay. It's the same type of thing. So I tell everyone in August, you're going to receive a paper in the mail from your county that's called a truth and millage notice or a trim notice, and that'll tell you what the value of your property is going to be for that year. And you only have 25 days from that date to appeal. And it's in very small writing, so a lot of people miss it. So just remember, it's usually around the second or third week in September when the deadline is. But I tell everybody, if you call me in July or August of every year, every summer, I will run a free property analysis to let you know whether or not you have a case. And if you do, you can decide at that point if you want to hire me. And then I just get paid based on a percentage of whatever I save you. And if I can't save you anything, you don't owe me anything. It's that simple. So that's really how it works. The whole process usually takes months. It takes from the time you sign up in September. We usually don't get results on a lot of properties until March or April of the next year. So people pay their taxes in November. You take advantage of the 4% discount. And then if I get it lower, you get a check back from the county.
Excellent. Great information. So what have we not discussed about property taxes that we should have discussed? What have I not asked about property taxes that I should have asked?
I think you pretty much covered it. Obviously there are nuances to, whether you transfer it while, into a trust, or there's so many nuances to the whole thing. But for your typical transaction, we more or less covered it. Like you said, 2% is your estimate. People want to know what they're going to be paying. Sellers want to know what they can do when they buy another property, how much they're going to be able to port over or take over from their previous homestead. Now, remember, just to mention, if you go out of state, you lose that portability. So if you move to Georgia, you're not going to be able to take that portability with you.
I have a situation just like that. They're moving from Miami to Georgia ultimately. So you just answered that question right there. Another question that comes to mind, somebody wanted to buy now in Tampa and they still have their homesteaded property here in Miami. Can they, at a future date, port over? You're saying within 3 years, I believe? They can buy it now.
That's correct. A lot of times when we talk about this, we think of the starting date of the portability as the date when you sell the property. It doesn't have to be that. The law says it's when you abandon your homestead. So if you have property in Tampa, it doesn't matter where you have it, and then you buy another piece of property, the minute you change the homestead from one to the other, that's the date that 3 years starts, because it's when you abandon your homestead. So if you have property in Tampa, you buy the property in Miami, but you still have homestead in Tampa, but then when you move to Miami, you're going to keep that Tampa home. You're going to lease it out. That's fine. But the minute you abandon your homestead in Tampa, that's the date that the 3 years begins. And if you want to put that homestead on your property in Miami, if that's where you're living, you can do that. Or if you're only in an apartment in Miami temporarily because you're building a house, you can wait until that house is built and then put the homestead on that, as long as it's within the 3 years.
Gotcha. Excellent. So question, how does someone contact you, Seth? What's the best way to contact you if they have more questions on taxes and tax appeals?
So I'll put it in the chat. The best way to get me, you can call me, you can email me, you can go to my website, and I'll put my website in the chat. It's lubinlawfirm.com. My email address is just seth@lubinlawfirm.com. And my phone number is 954-660-3556. Any of those ways you'll be able to get in touch with me if you have any questions. I love answering questions. People have a quick question. It's not a major thing where it takes a lot of investment and a lot of time. I'm not going to charge somebody for a phone call. If someone has a question, especially if they're coming from your seminars, Jason, I have no problem answering any questions.
Thank you,
and
Seth.
if they want to fight their property taxes, give me a call over the summer, and I'll be happy to run a valuation analysis for you.
Excellent. Thank you so much. Really appreciate the hour you've invested and the knowledge you've shared. And for those of you on the call, thank you. Thank you for investing some of your time. Hopefully it was helpful. And yeah, well, stay tuned for the next one. It's going to be something to do with downsizing, or if you want to put something in the chat, I'm open to suggestions on what the next topic can be: inspections, staging, moving, etc., whatever it might be. All right. Well, thank you. Glass blowing. That's it. That's the next one. Glass blowing. All right, everybody. Thank you so much. Thank you, Geraldine, for putting this together. Thank you, Seth, very much. And
Thank you.
Have a great evening, everyone.
You too.